Richard, a lot of questions in the market. We've gotten past the initial debt ceiling dispute. Why now?
Well, I mean, we did right after the resolution of the debt ceiling with the Fiscal Responsibility Act, mind you, just 2 or 3 days ahead of the X date when they could possibly not make some kind of payments on its obligations. We indicated then that we would resolve the rating watch in the third quarter. And we wanted to take our time. We wanted to opine upon the impact of the Fiscal Responsibility Act itself on the deficits and on the debt level. We wanted to update our own numbers and look at where we think the fiscal trajectory and the debt is going. And we wanted to just take stock of the actual debt ceiling debate and its resolution as well. So we wanted to take our time and give a thoughtful analysis to both the fiscal picture and on the kind of governance issues and as well.
It's worth talking a little bit about the criteria you set out about a year ago, about what it would take to get to a downgrade, because some of the things have changed in terms of the picture. Let's start with the rise in debt to GDP ratio. The significant and sustained rise did not be so significant or sustained. So why is that not factored in here in terms of the decision made more recently?
Well, the debt level has been rising quite significantly. If you look at before the great financial crisis in 2007, debt to GDP was at below 60%. Now it's 113%. The 113% is almost 3 times higher than the AAA median, and it's more than twice as high as the AA median. So you've had a sustained deterioration over the years. Yes, debt to GDP peaked during the pandemic at 120% and has come down, and that's because of inflation and high nominal GDP growth, and also the withdrawal of the stimulus, especially last year. But now we're seeing debt levels starting to rise again, and we do not see them stabilizing. We just see them continuing to rise. In the next 3 years, and probably more over the medium term. And that 113% is still 13 percentage points higher than where it was before the pandemic. So you've had quite a deterioration on the fiscal and debt side.
But what about the macroeconomic policy here, the performance and the prospects moving forward? Because in theory, this would have been improved a lot from where we were just a year ago. How is that factored in?
Well, I mean, obviously the macro picture is very important. We are still calling for a recession in the fourth quarter and first quarter of next year, a very mild recession. If that turns out to be if for whatever reason the U.S. is able to avert a recession, that's positive news, no doubt. But honestly, it doesn't really move the needle in terms of the underlying analysis. The deficits will remain high no matter what. And that the GDP is going to continue to rise no matter what. And so, yes, we recognize that one of the strengths of the U.S. is its dynamic economy. It's a large economy. The per capita income is high in the United States, and that obviously supports the tax base. That's actually is one of the key rating strengths. But I don't think it's enough to offset the deterioration we've seen on the fiscal and debt side.
I'd love for you to respond here to Treasury Secretary Janet Yellen, who said that she disagrees with your decision and that it is based on outdated and arbitrary, based on outdated data, I'm sorry. So if it is indeed based on outdated data, do you agree with that? And does that change the way that you look at the picture moving forward?
I understand why she's not happy with the downgrade. That makes sense. I think what she's referring to specifically are governance indicators that we use from the World Bank. They come out once a year. They tend to be a little bit backward looking. We use it because we have that data for every country in the world, and it comes out once a year, and we're able to use it for comparison's sake, and not just say it's Fitch coming up with this this underlying governance. So yes, it's a little bit backward looking, but I think more importantly, over the last 2 decades, you've seen, again, a deterioration in even these indicators. The United States started kind of at the top of governance, toward the top at 91 percentile, and now it's down to 78 percentile. So again, you see a kind of continuous deterioration over the last 2 decades.
What does this mean for the risk-free rate here? If the idea here is that treasuries are not as risk-free as they had been with a gold standard AAA rating here, what does this mean for broader markets? And do other countries, do other securities face further risk of downgrade given how much the treasury market had underpinned the financial markets?
I think one of the rating strengths of the U.S., the other key rating strength in addition to the dynamic economy that I mentioned earlier, is the reserve currency status of the United States. It's unparalleled. There's not really much of an alternative. The Treasury market's deep and liquid, and this gives the U.S. government tremendous financing flexibility. And I think that is a very key rating factor. And the other thing I would have to mention is, AA plus is the second highest rating we have. It's not a low rating. It's not, it's still a very high rating. It just we're just saying that we do not think that the underlying fiscal story and the governance, is compatible with AAA anymore.
Bring us inside the conversation you've been having with the Biden administration about this, given how heavily they disputed your decision.
Well, I think, part of the rating process that we have across all the sovereigns that we rate, we do have conversations. We do, obviously take, facts and figures and different things under consideration when we talk to them. And so that's not unusual. And it's a similar conversation we would have with any government.